TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. We're going to have Rich Anderson on from Anderson Capital Management on the Commodity Hour at the half hour. And there's a lot of things that are happening in the commodities markets that probably a lot of you folks might not be aware of. But he'll discuss those as we go through. But I think the thing that really we should have in the forefront today is the gold and silver markets, because we talked about that yesterday, the fact that gold went down to that 1558, which was a 618 retracement coming off of the low at 1539, and that's been very important. And the first chart that I posted into Tiger TV today is the silver and gold chart going back over the past month, and it's an hourly chart, and it shows the blue line will be the gold line, and the silver line will be the bar chart. And if you'll notice, the silver is actually selling off much less than the gold. The gold came down to the 61% retracement, and the silver was only able to make the 38% retracement. This could have potentially bullish ramifications, but we have to give it some time. It really is. This is a fight for its life in gold, in my opinion. I don't know if that's right or not, but it certainly looks to that extent that that's what it is. The chart that I'm going to put on next is going to be this. Is the longer-term gold chart. It's going to be the weekly chart, and you'll see why I think we're in a fight for its life, because we have reached the 61% retracement. This is the fourth time that we've been down here since January 2011. We hit the same 1540 area. We hit 1539 just the other day, and this is the fourth time that we've been at that level. That means there's just a ton of support here, but if it breaks, look out. It could easily go down to the 1375 level, which is the longer term 786. But it's holding in. Silver for the first time is actually really holding up better than gold. This could be a very positive thing. Now, when we were on the show yesterday, the gold was trading at around 1572, and we were pointing to the 1558 because we were breaking below those previous lows, and the first target down there was the 1558 level, but it was coming down very, very fast. And what we suggested at that time was to, have a little bit of patience and wait and see if the market would form another pattern as we got closer, to this level that we were looking at. So what I'm going to do here is to give you a, tiny little refresher course in pattern recognition, and you'll be able to see on this 15-minute chart that goes back over yesterday the fact that the first low that we made down at the 1558 level, the market rallied up about $6 or $7, and then it came down and made a three-drive to a bottom pattern at 1554. That's $4 under the fib point, which is, when you're talking about a contract that's $155,000, that's basically insignificant. But then the market, rallied back again, another $7, and then it made a beautiful ABCD Gartley again down at the 1555 level, and then had a nice rally, the best rally that it's had so far of $11, and then it pulled back one more time to the 786 level, again at the 1557 level, and then since that time it's gone up to the 1568. Now this is the way that we try to handle risk, because we never know whether we're right or wrong on these trades. That's for sure, and you never know how much you're going to make on a trade. Those are the two givens. So the only thing you can control in the risk reward equation is the amount of money that you have to risk. So you must focus on the amount of money that you have at risk. So as long as gold can stay above this 1555 level on a closing basis today, or any basis, if it goes below 1555 late in the day, it's not going to look very good. But silver is holding up really well. Silver should have gotten down to the 26.70 per ounce level, but in fact it couldn't even break below 27.30, and it's acting much better than it's acted in a long time. So this is the main thing that we're watching in the gold market. The XAU, which is the gold silver index, has also held up relatively well on a long-term basis, and we've watched this on the weekly basis many times before, and we've held up at this level. We're trading just a tad below the 61% retracement level, and I'm going to post this in here to show you why that it's important that gold hold this, because if we break below that 1555 level in the gold, that's going to tell us that we're heading down at least another 20% in gold. That would be another $200. That gives us this 1375 figure that we're looking at, because once these numbers don't hold the 61% retracement, they're pulled to the next level of the Fibonacci ratio, which would be 786 on the retracement, and just almost like a magnet. Now but so far it's holding. I mean, gold has done what we thought it was going to do yesterday. It's given us a little bit of hope, and believe me, HOPE is not a good trading word, but there is a glimmer of that in the gold market if it's able to hold that level, and that's the real key that we're watching in the gold market. This is really important. There's a lot of news in the on the internet, of course, and then also in the financial press about gold stocks and some other things, and the fact that the countries are moving more to a gold standard and things like that. Folks, I do not see how they're going to move to a gold standard. There's not enough gold in the world to support the amount of currencies that are out there if they all move to a gold standard. So until somebody comes up something better than the U.S. dollar, I will stand by the U.S. dollar as near as I can tell. So that's all I'm saying as far as the U.S. dollar, and gold. I don't really worry about that. In 1972, Nixon took us off the gold standard. He basically broke the Bretton Woods agreement that started in 1944, that basically put Europe back together, particularly London. And gold began trading at the CME. I think the first trade was at about $120 an ounce. Before it had been pegged at $32 an ounce, and from there it went up to about $180, and then backed off to $130 or something like that. And it stayed into a trading range for quite a while, and didn't really become active as a really active commodity till around 1974. And then it began to, have some pretty big swings, and then it started to move better. Now, silver had been trading since the early 60s, and so it had a lot more volatility, a lot more traders and everything at that time. And it stayed in a range between about $2.50 per ounce and about $4.50 per ounce. My big move, I'll give you a little history lesson here, since this is our radio show here. The reason why I'm in this business, and the reason why I've never worked for anybody other than Drexel Burnham, all these years, is because of the silver market. My college professor, Dr. Noblet, said, you buy silver because Gresham's law, bad money will drive out good money, and that bad money was paper money, and good money was money that was backed by silver. And so, he said silver certificates were the thing to own, and I bought silver certificates at $1. Their face value, and I sold them at 2.5 and 3 times face, and I was only a kid. I was only like 21, 22 years old, and it was a huge amount of money for us. It was at that time. It was about the cost of about 7 or 8 automobiles, and so it was a big change. And I said, wow, why do I want to be a pharmacist when I can make money like this? Well, that started my career. And of course, I went through several major changes. One in 1974, of course, and then, of course, when Drexel went bankrupt in 1988. But anyway, those are things that you have to go through, in life, and when you see things that have occurred like we've had this year with Peregrine Financial, with Russ Walsendorf, not being the person that I thought he was, and I'd known him for a very, very long time. And then also with John Corzine with MF Global, when things like that happen. But, they've happened in other things. Look what they did to Bear Stearns. Look what they did to Lehman Brothers. I mean, those were orchestrated to get rid of Lehman Brothers because they were the number one competitor of Goldman Sachs, and Goldman Sachs didn't want them around anymore. And you've got Henry Paulson running the Treasury, and it doesn't take much, when you've got the chief there to get rid of him. And when they tried to buy him out, they wouldn't approve it, and so away they went. Anyway, that's the way that it went. It part of those things affects families all over the globe, and that's it happened to affect our family to a small extent, but it still does affect it. But these markets are going to continue trading. They're going to get very, very, very volatile, and so just try to trade what you see and not what you believe, because, your opinion really doesn't mean anything. It's the amount of money that you have at risk in these markets. That's the only thing that counts, the absolute only thing. You don't have to be right all the time. You can be right 50% of the time. If you watch your risk, you're going to be okay. That's basically the bottom line, the things that we're looking at. I was speaking to Rich this morning for two reasons, but there's a lot of things happening in the commodity markets, and many of them are happening abroad, and I wanted to save that for him when he comes on the show at the 12:30 hour, and we will cover that. We're getting ready almost for the first break, but on after the first break, I'm going to talk about. I'm going to try to get the chart in right now, if I can, and because I think it is one of the more important ones of the things that we're looking at right now. And if I can just grab it really quickly, here it is. Just give me 1 second. It's the high yield bond market, and this is truly an amazing chart for me, because this is I work for Drexel Burnham, and so I know a little bit about how the history of high grade bonds came out. And these are high yield bonds, also known as junk bonds. And as you can see, they've been going up for the last 5 or 6 days, when we've been coming down for the last 4 days in our 30-year bond. In other words, high grade paper is being bought more than the 30-year Treasury bond, because people are searching for yield. And I always remember what Bernard Baruch said: don't be concerned on the return on your money, be concerned on the return of your money. So you want to make sure you get your capital back, and that's the real key to this. If you remember Warren Buffett during 2009, when he lent Goldman Sachs $4 billion, he got some stock options, but the main thing was that he got preferred stock that had first preference to be paid, even over to bondholders. Anyway, we've got to take a little break. When we get back, we'll talk a little bit more about the bond market.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads, so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
Okay, we're back, folks, and I posted into Tiger TV a chart of the Japanese bond, which is equivalent to it's their 30-year bond. And this is really an amazing chart, folks, because it goes back over the last 4 months when they started this quantitative easing thing, and when we saw the big move in the the Japanese yen against the dollar, which we were fortunate enough to be on a big portion of that. But the percentage of drop in this bond, the yield, is just absolutely phenomenal, from 2% down to 1.2%. On a percentage basis, folks, that is almost 50%. This is really a game-changing thing. Now, they've made a huge bet, the Japanese Bank of Japan, just like Bernanke has. These are experiments. Now, in all the years of going through financial markets and everything like this, going back to the buttonwood tree in 1792, we've never had anything like this. So this is a giant experiment. Whether it works out correctly or not, no one's quite sure. There's a lot of there's two sides to every story. There's people like David Stockman that thinks it's going to end in disaster. Bernanke's not sure, or not Bernanke, but Greenspan is not sure what's going to happen, and there's just 50-50 probably, but we have to watch the price action, because if we were to get a a normal interest rate in the 30-year bond is trading at around 2.8 now. But if we would get back to around 5%, where it was trading in 2007, this would be devastating to the United States. And the reason why is there's so many bonds out there that are paying interest, and this is why our debt is going through the roof. And this is a bad thing. We're paying credit cards off with credit cards, and that doesn't work. And it's just not a very good thing, to really have happened. And at the same time, I'm saving the stock market stuff to last because I was stopped out of the last part of my S&P trade yesterday. I sold it at 84, and I got stopped out at 89, and I'll be looking to sell it again today. Because I'm still very close to the new moon, and the new moon, when they make highs like this. So yesterday was the new moon, and it has a one-day orb, so we've got Thursday today. But if we get a rally back to that 1591 area, I'm probably going to try it again and risk another 5 points. And I keep nibbling away at that, and that's really what keeps me in the game. I've had a really good day, even though I got stopped out of the S&P, because I had bought gold, and I was already long some crude oil, and the euro had been treating us, quite well. So it's a matter of probabilities, and it's a matter of risk control, and that's what it's really all about. I'm also preparing for a major strategy in the corn and beans and wheat that were not right yet, but they will be soon. And this is what we were doing last April. We had Rich on the line just about every other week, because we were preparing for a potential of something big happening in the grain markets. And of course, we had the big drought. And then after the market rallied up and priced everything into the markets come down, and now some of them are trading far below the prices of where they broke out before. We'll talk about this when Rich comes on, but you can buy December corn. This is new crop corn, the corn that they're planting right now during the April, and it'll be planted by the 1st of May. That corn won't be harvested until October or November. That's new crop corn. It's selling for $1 a bushel less than the current corn. In other words, there's a big demand for current corn, but because we're going to have a huge crop, supposedly, they're giving away December corn at $1 a discount. So what we want to do is we want to watch that discount, because anytime they're pricing things under the market and you can find a pattern that lines up nicely with that, then that increases your probability of success, because these are demand-driven markets, but they all act alike. I posted a chart yesterday on Microsoft and Apple and how they looked alike, and they certainly do. And someone just asked me a question: do I still think that Apple is going to make $3.94 a share? I see no reason why. I mean, it's rallied from $4.22 up to $4.37, $15, and it has really done pretty much nothing. I mean, considering the stock market is on fire, Apple looks like a piece of dead meat. It's just not doing very good. But take a break. We'll get back. We got Rich Anderson.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed down a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and we have our friend Rich Anderson on from Anderson Capital Management from sunny Minneapolis. I think you have, 80 degrees there today, Rich?
Oh, at least, except for the blizzard.
When I talked to you this morning, you said you wouldn't be able to get out of the house today. Is that true?
Oh, I shoveled the driveway. But it's not going to be over 50 for the next 8 days. So it's still going to.
Is that 50 feet or 50 degrees?
50 degrees, and
okay.
You know when you're planting, and of course it's way too early about planting. But when you're planting, the soil temperature is important. You know, the frost isn't out of the ground here or in South Dakota, and so. Yeah,
speaking of South Dakota, your brother's got to be in about 12 feet of snow, doesn't he?
Well, no, they got plenty out there, but it goes horizontal out. It blows, so they get snow here. It comes down. But out there it blows, and so you get the big drifts. That's what makes a mess.
Rich, when we were talking this morning, you were mentioning about the bird flu in China, and of course Sarah and I watched that closely because we travel there and we stay in Hong Kong sometime. And give me your thoughts that you were telling me about this morning.
Well, I don't follow stocks per se, but Yum Brands, as an example, reported that their KFC restaurants, their chicken restaurants in China, opened more than a year. Sales in March were down 15%. And that's when the bird flu was just starting to raise its head, and it's gotten worse, not better, since then. And that gives you some idea of the change in demand that can occur, in the usage of your corn and meal. These are macro things, and it takes a while for them to come into the world that we're trading in, which is much shorter term. But there are things you need to be aware of. Just like, as an example, the quantitative easing that's going on in Japan makes our Federal Reserve look like a piker. Our Federal Reserve expanded its balance sheet by 2.5 times in the last 3 years. Japan is looking at which their balance sheet, by the way, is roughly 25% of the U.S. GDP. Japan is talking about expanding their balance sheet to be the equivalent of 60% of Japan's GDP. So another primary market for our meats and our proteins is Japan, and look at what the yen's done. And the yen going down, if I'm in Japan trying to buy pork, as an example, it's all of a sudden got a lot more expensive because my yen's worth so much less. So all these things are interrelated, and that's why it's almost impossible to know about all of them all the time. You need to be a technician, in my humble opinion.
Well, there's so much fundamental things that it's really difficult to grasp it all. Now, Rich, I was talking to our folks on TFNN today about the difference between the corn that we have for May corn and what we have for December corn. That big differential. Could you give us your opinion of what is what's causing this huge differential? Because this is major.
Right. Well, we had that March report. That was a shocker, and they talked about how we had 400 million more bushels of corn. The USDA said we had 400 million bushels of corn than what most people thought. And the markets reacted by going down almost $1. But the real world, if I'm an ethanol plant in Iowa, let's say, I've got to buy cash corn in order to grind that in my ethanol plant. And if I can't buy that corn, I can't grind it. And there are several ethanol plants in Iowa that are thinking about closing down because they can't get any corn bought in their areas. There isn't any. So when that report came out, the markets crashed and burned, but the things you had to look at were the real prices, the cash basis, and the spread relationships between like May and July or May and December. And that's reflecting the real world. Now, the report yesterday came out and said, well, it wasn't really, of that 400 million, maybe 130 million. Is what that report was looking at, and so that's why the corn's been going up since then. But then if you looked at the report yesterday, there was a big pop early because the U.S. numbers are friendly, and then the next numbers to come out are the world numbers, and all those increased, and then the market sold off. But then corn came back late in the day. The bottom line is that X amount of corn needs to be used every month. And these elevators, these feed plants, and these ethanol plants are having a hard time buying that corn in the country. And the exporters are having a hard time buying it in the country to get down to the ports to ship.
Mm-hmm. How about the condition of the soil? What do you think with all this ground cover we're having? You think that's going to replace all the moisture we lost from the drought last year?
It's replaced maybe 10 or 15%, but no. As I told you last time I was on, Minnesota as an example, we were 3 inches below normal in August, September, and October. That's 9 inches. The snow we received, the snow today, maybe 6 inches of wet snow would equal maybe an inch of rain. A normal snow, it's maybe 12 inches of snow to equal an inch of rain. So we picked up some, but we're way behind.
So any dry, hot weather will bring on drought conditions again.
Right. And it's too early to worry about not getting the crop planted because nowadays we have such big machinery. But if we are talking a month from now and we still haven't gotten more than 50% of the crop planted, then it'll be time to worry. Then you'll start to see the new crop, the December, start to hold its own. If we plant the 97.5 million acres they're talking about, we could have a carryout next year of a 1.5 to 2 billion bushels, and you could have a $4 corn.
We can't store that much.
Probably not. Well, what we do out in South Dakota and in Minnesota is we just stack it on the ground, and it kind of develops a half-inch crust, and then it's good till spring, because once the spring comes, then it would get moldy and spoil, but it'll store through the winter.
Okay, let's move over to the cattle market, because we had a really good move from the 18th of March into the 1st of April. We had a 4-cent move in cattle that was quite profitable, and now we went down and we took out that low in June cattle by just a few cents. I mean, less than $40, and now it looks like there's a potential for a double bottom in the June cattle. What is your feeling on the cattle market, say, over the next 3 to 4 weeks?
Well, the next 3 or 4 weeks, the cattle traders will mainly be focused in the April cattle, which for your average person, you don't want to be doing that because we're in delivery. I mean, I do it all the time, but don't try this at home.
You mean June cattle is getting ready for delivery?
No, April. April
of course,
cattle.
April. Yeah, they're selling at a high premium to the June, though.
But they're a discount to the June. June is typically the weakest demand month of the year, but it's already reflecting that. It's $5 under, and we need to hold here, and I think the market action is indicating we're going to hold here. But people are worried about the demand. There were some 128 cash cattle traded at $128 today. And the April board is $1.2570.
Wow. Now, would you go to August cattle? That would be the one you would move out from June. Would you go to August?
Well, see, they sequester, and they're going to furlough meat inspectors starting in July. So basically, I'm liking the August. Typically, in a typical year, you would buy August and sell June when it was 50, 60 cents over, and looking for it to go out to $2 to $3 over. That's typically what happens. The question I have this year, and the sequester, they're talking about furloughing meat inspectors, so that would slow down the chains. Instead of a 5-day kill, you'd only be killing 4 days a week. And do we get to the cattle? Is there a backlog? And so those are the questions I'm having about that. The other thing is if I'm a low-income worker, and all of a sudden I'm starting to pay these extra taxes that I hadn't paid last year because we had a holiday on it, trying to stimulate the economy, I'm feeling that. It's only 2% maybe, but I run on a pretty tight budget. I spend all my money. So that is, the demand is not great. Typically, from the spring highs, cattle prices will drop $10 to $12 into the summer lows. That's one of my friends down in Texas always said, "Gentlemen, don't trade cattle in the summer." And you kind of, the one I'd be watching would be the Octobers, to make a low. The thing is, we've already dropped that $10 I'm talking about.
Sure,
so
that's correct. You were warning us about that months ago, back in February.
Right, and so the April cattle being under the cash, though, tells you there's no real urgency. Otherwise, wouldn't they be pushing those April cattle up?
Yeah. Rich, I have what I think is a real important question for our listeners. The overall, correction that we're having, it's a bear market, really, in these commodities, gold and silver, platinum, copper, sugar, all of these things are just getting massacred. Can you give me your overall view of what you're hearing from some of your hedge fund clients of what's happening? It's just really amazing because stocks keep going higher, bonds keep going higher, and commodities keep crashing, and there's usually a high correlation between them moving.
Right, and I just explained how Japan's going to increase their balance sheet, and that that's printing money, and that money will go someplace, and eventually it'll come back into our markets. But yesterday you had two things that I thought were interesting. One, Goldman Sachs, you've heard of them.
Yes, it's a firm in New York, correct?
Yeah.
Yes. Okay. Yes, I heard of them.
We think gold's going to $1,450 and $1,250 by next year.
Mm-hmm.
Well, I don't know about you, but I've known over the years that from time to time, Cargill or whoever might put out a statement because they want to help the market so that they can accumulate. Now, I'm not saying that they would do that, and it's a big firm, and that might just be one guy's opinion, and there's a dozen other guys waiting to buy it once he puts that out on the street. Another guy was on Jeremy Grantham was on Charlie Rose, and he's talking about, well, I want to buy natural gas because I think our glut's going to end and it's going to triple in price, and sell corn against it to be a pairs trade. Well, corn is going to all completely dependent on the weather in the next 5 months. So I think that's a really dumb idea, although this is a brilliant guy. And as far as natural gas doubling or tripling, natural gas is double and triple if you look at Europe or any other place in the world.
Yes, that's correct.
It's we are a massively discount to the rest of the world on our natural gas prices. So he's correct, but it's already tripled in the rest of the world. And it isn't necessarily likely to triple here. We're a long way from that. You'd have to change all of our over-the-road trucks. That would take 2 years, probably. You'd have to build plants to export liquefied natural gas. That would take 2 to 3 years, minimum. But he is correct. I mean, natural gas in this country is very cheap, and it's 3 times as expensive probably in Europe or other parts of the world.
Wow. Rich, if I had to put you on the spot and say if you were looking at one particular trade over the next couple of weeks that our listeners could focus on, what do you think it would be? I guess I did put you on the spot, didn't I?
Soybeans. If I was going to pick one, if I was going to pick one trade, I'd probably be focusing on the soybeans. We still, we're still using more than we're going to have available to consume this summer unless things change dramatically. The primary reason there's still demand coming into this country is because there's so many ships waiting to load in South America, and it takes time, and it's probably 30 to 60 days at a time before that situation gets corrected. So I'd be looking at soybeans or soybean meal, and my simple, because I look at things as simple as I can. When I look at a report, I don't care what everybody expected or what they said. Did the market close higher or did it close lower?
That's what counts.
Yesterday the corn closed higher. The beans did close lower, but not by much. But here's the key: if we close above yesterday's flash high, when the initial numbers came out, that tells you these boys are believers, and you're going to take the beans back up to the highs 2 weeks ago prior to the March report, and you'll probably take the corn back up to the highs 2 weeks ago to the March report. So I'd probably look at the beans and the meal, maybe even as a smaller contract in the beans, and then the corn. That would be
it's amazing that the beans went right back to the 61% retracement of the December 2011 low down at that 13.60, per bushel. Right. And every time I see folks, Rich and I have known each other for 40 years, and back when we were kids and trading, there was always a thing about beans in the teens, because in 1972 beans hit $12.90 a bushel, and someday the old guys would say, oh yes, they'll go in the teens someday, and now they trade above the teens, and that tells you the demand for soybeans have been quite good all through the years. And if this thing with the bird flu is anywhere close, they're going to be eating a lot more tofu and soybeans in the world than they are, red meat and white meat and all the other stuff,
Well, that's true, but then the chickens and the hogs will eat less meal.
Yeah.
So it'll kind of wash. What I noticed, I was just glancing at a chart. The May beans pulled back almost perfectly 50% from the low of last week and the highs of yesterday. The first 50% correction, and now today it looks like they're going to, if they close right here, it's going to look kind of strong, and you would certainly expect that that would allow them to push back up to the highs of the last week in March, which is,
Rich, we got to go now, buddy. Listen, we'll have you on soon, okay? And I want to mention one other thing, okay?
All right.
Happy birthday to you, buddy.
Hey, thanks, Larry. Talk to you.
Okay. 877-927-6648.
No No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can't use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, folks, we're back, and I'm going to end the show here with a set of 3 charts. The first one, of course, is the one about the VIX index, and I wanted to, just to show you that I believe that the VIX index is held up incredibly well here. It hasn't collapsed these last few days. It's still holding above last week's lows, which to me is something short of a miracle, because I believe the chart that we posted earlier, showing that we're at 70% bullish consensus on a long-term basis. The only time we've had this in the last 15 years was the top in 2000, the top in 2007, and we're also making a new one right here at this particular level. So this isn't the time to be time to be bullish. Now I'm not in the short side anymore. I tried it yesterday, and I'll probably try it again either later today or possibly Friday, because Friday would be the last day that this possible new moon scenario would work. But that's what we're looking at, and we'll see if that's going to work. But I'll keep nibbling till I get it right, just like I have at other times. Now, the next one that I wanted to mention to you folks is to show you that the divergence that we're having in the Dow Jones Transportation Index, it's made that, very large ABCD up there that stopped exactly where it should have stopped. That has held up well. The NASDAQ has gone nowhere. It still has a completed head and shoulders pattern. And we're still at that 3-drive pattern in the New York Stock Exchange Index. However, we're about 0.5% higher than the last time we looked at it, which is not a comforting feeling if you're looking to be on the bearish side. But that's you don't always get your choice when you do these. You have to, pick your shots the best you can and nibble at it until you finally get it right. That's the real secret to the thing. I happen to be long gold. I bought the gold at 56 yesterday. I sold some of it out at 66, and I still think the gold has a chance. It's got to stay above 15.55. If it closes below 15.55, then that's going to be a very negative sign, especially coming into Friday, because it's the end of the week, and there's not going to be many people wanting to buy it over a weekend. So as long as it holds above that, that's the main thing that I'm looking at. Silver has been acting much better than gold on this run, and I have a real strong affinity to silver. I like gold more than silver, but I love silver. I mean, I love the silver coins. I love the luster of it, and it's really good. But I need to spend a few seconds here on what I think is going to be the big trade, and that is the Treasury bonds. If the Japanese are going to dump the bonds on the market like they did, and believe me, what Rich said was we are pikers compared with what the Bank of Japan guy did. He literally he bet all his chips, and if he's wrong, they're going to have a really hard time to pay this. And if you remember on the charts that I posted on yesterday's show, I posted the long-term charts on Japan and how they've tried this stuff before, not to this extent. This was the biggest one ever, and this is what's got the yen up to near par. But if they're wrong about this, which they've been wrong several other times, they go into new low ground. I remember that one of my famous things I remember from 1989 when the Nikkei was at 39,000. They had the CNBC people in right at the Emperor's Castle, at the Emperor's Place in Tokyo, and they put $1,000 bill, picture of Cleveland, President Cleveland's on $1,000 bill. They put the $1,000 bill on the ground, and they said, this is how much real estate you can buy in Tokyo for $1,000. It was about 2 inches by 3.5 inches. That's it, folks. Live every day in an attitude of gratitude, and may God bless all of you.